Hi guys, welcome back to my portfolio update in January 2025. It's been a crazy month and the DeepSeek crash has sent some of my biggest positions like NVDA plummeting. But what does that mean for my overall portfolio? Well, we're gonna find out today. I also had a very close look at DeepSeek and will use my background as a physics engineer and my expertise as a middle manager in a semiconductor manufacturing company to see what is really behind the media hype and what that means for us as investors. But first, I started off the year with a total portfolio value of 112,463 euros, split between 26,749 euros in ETFs and 85,713 euros in individual stocks. And my goal for this portfolio is to first bring it to 1 million euros and then to reach financial independence in the end. But I'm not there yet and it's still quite a long way to go. I am actually very curious what the year 2025 will bring for my investments and the stock market in general. There are currently so many uncertain factors that play a role here. From the dumbest trade war in history that was postponed before it even started, the AI mania as Business Insider puts it, to the high valuation of US stocks. But the general market at least was up by a little bit. The S&P 500 with plus 2.7% and the MSCI World even a little bit better with 3.3%. And this already includes the effects from DeepSeek that we saw last week. And while the general market, here the S&P 500 was mostly green, especially our big techs had a tough time and did decline quite a bit. Again, this was mostly the reaction to the DeepSeek announcements 2 weeks ago. This shows how nervous the market is right now and how quickly it can go south in case of any unexpected news. In case of my portfolio, at first glance the performance doesn't look too bad. My ETF portion did grow by 3.5% and my individual stocks by 8.7% even. But I've been very busy in November and December, and between YouTube and my day job, I barely had any time to think about where to invest. So now that I had some time to think over the holidays, I went on a buying spree. I increased 2 of my positions and even added a new company to my portfolio. So this picture does not reflect the true performance, but is good because of these new buys. We'll go over the details of what and how much I bought later in the video, but first, in order to determine how my portfolio actually performed without fresh money, let's look at it without the new buys. And with this, the picture changes all of a sudden. Now my ETFs are only in the green by 1.7% and my stocks by 1.3%, which leaves my overall portfolio performance at a very underwhelming 1.4%. So both the S&P 500 and the MSCI World did outperform me last month. One reason for this is that even though I'm trying to build a diversified portfolio over different segments and countries, I still have several US big tech stocks in my portfolio and these are also my biggest positions. And these big tech stocks have been exactly the losers in the last month. The worst performer last month was NVDA with minus 11.7%, followed by Texas Instruments with minus 3.8% and Microsoft with minus 2.7%. But all of these 3 companies are still up nicely in total performance though. My best performer of the month, and I'm blurring out 3 companies here because these have been the ones where I bought new shares, which distorts the picture. But from a pure performance point of view, the best stocks have been JD.com, again with 19.8%, Meta with 15.9%, and the European software compounder that I just bought last year, Dassault Systems with 13.3%. Go Europe, I guess. So percentage-wise, my best performers did gain quite a bit more than my worst performers lost. So why did my portfolio underperform then? We see the reason when we look a bit closer on my stock allocation from December. NVIDIA is my biggest position with 12% here, Microsoft my second biggest with 10% and Texas Instruments together with JP Morgan my third biggest with 8%. So this month's losers are my biggest positions overall, while the winners are still smaller companies for me, with Dassault Systems even being my smallest. But honestly, I am not worrying too much because overall NVIDIA is still my best performing stock and Microsoft is also still in the top 5. And I don't think that their growth is anywhere near their end. I also think that DeepSeek doesn't pose such a threat as many seem to think right now. This was bound to happen sooner or later, same as it will happen sooner or later that NVIDIA is not the only big player on the AI chip market. Let me break down real quick why I believe that the reaction on DeepSeek is exaggerated. While many news outlets report that their R1 model was built with only $5 million, many also claim that DeepSeek lacked access to advanced AI chips or may have even bypassed export restrictions. But this couldn't be further from the truth. Most of the info that I'll be referring to here is from this deep dive article from my go-to analyst when it comes to all analysis related to semiconductors, Dividend Patel, and his site SemiAnalysis. I'll put a link to the full article in the description if you want to read it for yourself. Here, Leonard Heim, an information scientist and professor of policy analysis, made this graph. And we see the chip situation in October 2022 before the current export restrictions on the left-hand side and the situation today on the right. The H800 chips that have been developed by NVIDIA to be able to sell their last generation chips, the Hopper generation, to China, is from a computational performance on par with the H100 chips that are used in Western countries. Only the network bandwidth is a bit lower, which has an effect on overall performance, but not such a big one. With today's restrictions, only the H20 chips that have a much lower performance are available anymore. So before the strict export restrictions were in place, DeepSeek did have many chances to buy the H800 and before that even the H100 chips from NVIDIA. And they did. Mr. Patel estimates in his analysis that DeepSeek had access to 10,000 H800, 10,000 H100 and many more H20s. In total, they think that they even had access to around 50,000 Hopper GPUs. And many of them have been bought years ago. And even before any of these restrictions have been in place, Highflyer, the hedge fund that is behind their spin-off DeepSeek, bought at least 10,000 H100 chips. So with these numbers in mind, SemiAnalysis calculated that the rough costs that DeepSeek and Highflyer invested are closer to 1.6 billion. And on top of this comes the cost of operation that they estimate at almost 1 billion for 4 years. This brings the total necessary costs to over 2.5 billion. This is just a tad bit higher than the 5 to 6 millions that are widely reported. But it is still lower than the tens of billions that US companies are investing. But we also shouldn't forget that it doesn't include any R&D costs or salaries for their teams. In his analysis, Dividend Patel goes on to compare the performance of different AI models, including DeepSeek, with different benchmarks. And to make it short, while DeepSeek's R1 performance is very good, it is not years ahead of any Western models. What the press never mentions is that it is basically on par with Google's Gemini Flash 2.0 thinking model that was already released a month ago. This is also already available and even cheaper than R1. And it is also no surprise that this is happening. As Leonard Heim, the AI researcher and professor from before, already explained in a paper from last February, the costs for AI training has decreased by 99% between 2017 and 2021. That is just 4 years. And we should not forget that ChatGPT's 4.0 model that is mostly used for comparison is almost a year old already. So all in all, while I think that it is remarkable what DeepSeek could achieve with the resources they had and as a startup, it is still a bit early to already announce the death of all Western companies that are involved in AI. I think that this will just be an additional part in the huge AI puzzle and that the involved companies still have a long way to go and grow. And to come back to my portfolio. That is why I doubled down on this, and my latest new addition is also coming from this sector. If you want, you can leave a comment down below with your guess what the company is. Because before we go to the new buys, the earnings season has also started last month and several of my companies did show the latest reports. And while you're down there, don't forget to hit the like button and subscribe to the channel so you don't miss out on my next update. Thank you so much. But back to the earnings season. First, JP Morgan kicked off the season with their report on 15th of January, Texas Instruments followed on the 17th, Microsoft on the 23rd, and my utility company NextEra Energy closed the week on Friday the 24th. Then we had the reports last week from Visa on the 28th, Danaher and ASML both reported on 29th, and last but not least, Meta on the 31st. Danaher was most interesting because of what the market did after the report, and that is crash by around 10%. The company reported their fourth quarter with a year-over-year revenue that was basically flat compared to their last fiscal year. Their EPS declined by 1.3% in the same period, while their free cash flow increased by a small 3.5%. So last year was a tough year for Danaher, and in their management commentary, they also forecasted a small decline for the first quarter of 2025 and only a small revenue growth of around 3% over the full year. And my guess is that this mediocre outlook was the trigger for the sell-off. But I still think that the long-term prospects for Danaher are immense. And Rainer Blair, the CEO of Danaher, said this in the last management commentary. Looking ahead, we believe that Danaher is better positioned than at any point in our 40-year history. The transformation in our portfolio over the last several years has created a focused life science and diagnostic innovator poised for high long-term growth, expanded margins, and stronger cash flow. And they really seem to believe that. They have bought back shares on the largest level the company has ever seen in its history, and at the moment they already have a new share buyback program in place that is even bigger. So I still think that they are a great investment over the long term, even if this year will be a bit slower. That is also the reason why I bought 6 more shares of Danaher on the 9th of January, unfortunately a bit before the huge dip. But that brings my total investment in them to 5,150 euros, and my overall position is still in the plus by 18% since I first bought them. The second report I want to highlight is from Meta. On a year-over-year basis, they could grow their ad revenue in every quarter and in every region. Overall, they could increase their revenue by 22% in the full year 2024. And what I find even more important is that they could also continue growing their DAP, the daily active people on their platform. So, despite tough competition in the social media space, their ad revenue is still thriving. And regarding their efforts on AI, their augmented reality glasses, and the metaverse, Zuckerberg just said that they continue to make good progress and they will scale these efforts further in 2025. I wonder when they will start earning money with this. But I find especially the efforts with their open source AI model Llama very interesting and think that this has a lot of potential. I didn't buy any more shares from Meta though. But instead, I bought a bit more of my German utility small cap company, Energiekontor. As a utility provider and developer of renewable energy projects, they have had a tough couple of months. Since August last year, the stock has lost around 33%. But they are still returning a lot of money to their shareholders by buying back shares constantly and increasing their dividends. Over the last 5 years, they have increased their dividends by over 17% annually with a current yield of 2.7%. There are only 3 analysts that cover the company, but they see an average 1-year upside of 180%. I think that these estimations might be a bit too optimistic, but I still believe that the stock is vastly oversold right now. So I'll keep using this weakness to increase my position and over the long run, benefit from their huge dividend growth. The third and last buy I did last month and my newest addition to my portfolio has been, drumroll please, the Taiwan Semiconductor Manufacturing Company, better known as TSMC. I bought 15 shares just a couple of days ago on the 29th of January. So I used the DeepSeek crash to enter a first position on what I believe was quite a discount. I was debating on buying Monolithic Power instead, and I think that they have a good chance to have the better performance in 2025. But my goal is not to have the best performance in any one given year, but to own the best companies and focus on compounding and long-term dividend growth. I also want to reduce the overall US portion of my portfolio, and monolithic power would have further increased this. And as a third point, the valuation of TSMC is much lower than monolithics, which leaves more space for mistakes. And if you're wondering who TSMC is, they are the biggest semiconductor foundry in the world. That means they produce the chips for other companies like Apple, NVDA or Broadcom. At the moment, they have an overall market share of 64% and are by far the biggest player here. And they could even increase this market share steadily over the years. At the moment, it is at the highest level ever. But it doesn't even stop here. The expectation is that this will further grow in 2025, and the reason for this is very simple. While their overall market share is at 64%, their market share when it comes to the most advanced technology, the 3nm chips, is even at 90%. And because these are the most advanced chips at the moment, the demand and the growth in demand is huge. Of course, AI plays a role in this demand, but so does the digitalization and the general need for advanced chips in many aspects of our lives today. These high-end 3nm chips already made up 26% of their revenue in the last quarter, and this has been rising steadily. And the thing is, the limitations here are not the customer orders, but the production capacity of TSMC. That means that they just can't produce these chips quickly enough. You might have heard of the delivery limitations of NVIDIA's AI chips, for example. Yeah, this is exactly the reason for this. So, to make it short, I believe that TSMC has a very strong market position and a huge moat. And on top of that, they are also growing the dividends very nicely with a double-digit growth recently, so they are fitting very nicely into my strategy overall. That has brought my current portfolio allocation to this. Some of the weight of my big tech stocks like NVIDIA and Microsoft have been shifted to mostly TSMC. But my new buys in Danaher and Energiekontor have also slightly increased their market share, and JP Morgan did also gain some weight even though I didn't touch them. And that leaves the dividend payments I received in January, which is actually one of my weaker months for dividend income. But I still received 3 dividend payments, and Microsoft started off the year with their payment of 76 cents on the 2nd of January. On the same day, Meta also paid the dividend of €1.91. And lastly, VG paid their first quarter dividend of €80.78 on January the 13th. So in total, I received €83.45 in January. This might not sound much, but when we compare it to the first quarter of 2023, when I started my detailed tracking, it is already almost as much as I received in the full first quarter back then. So I am really curious how the picture will look at the end of the quarter. And speaking of the first quarter, my plans for the coming months are to further reduce the US weight in my positions, not so much by selling, but rather by increasing my positions in European stocks. The 2 stocks I have in mind mostly here are, first, the consumer staples Ahold Delhaize that also doubles as a more defensive stock, which I like considering the high uncertainty and nervousness of the market right now. And secondly, my third top performer of the month, Dassault Systems. I also have the pharma stock Novo Nordisk on my watchlist and might add them to my portfolio. But I'm not only looking to buy. I am also still debating whether I should sell some of my positions, namely Texas Instruments, DHL and Rio Tinto. The thing is, except for Rio Tinto, my investment thesis for Texas Instruments and DHL still stands and is still true. But I am starting to think that these companies will underperform the market for the next couple of years for various reasons. So my money might actually be better spent elsewhere. Tough decision, but I will keep you updated. And guys, as I said earlier, I am still trying to figure out how to do this format in the most interesting way. So if there is anything you missed in this video or any particular part that didn't interest you so much and you think that I should skip in the future, please let me know down in the comments. And if you're interested in 3 of the best data center stocks to buy after the DeepSeek crash, I have the right video right here. That being said, thank you so much for watching, guys, and see you next time.